Welcome to ES Gold. This is your daily outlook for gold, XAUUSD, for Friday the 26th of June, 2026. Today we break down gold's drop below $4,000, Thursday's red-hot PC inflation report, the hawkish Federal Reserve Under Chair Kevin Warsh, the one-year high dollar, central bank demand, and every key technical level you need to trade today. Where gold stands. Spot is trading near 4,000 to 40.30 after a brutal week. On Wednesday, it crashed more than 3% to a low of 39.64, its weakest since November 2025, before clawing back the 4,000 handle. Price sits below every major moving average. RSI is around 27, and the short-term bias today is bearish, but deeply oversold. What changed this week? The week of June 22nd to 26th was decisively bearish. A hot inflation print, a Fed now pricing in hikes rather than cuts, a dollar at a one-year high, and a holding U.S.-Iran ceasefire that drained safe haven demand combined to drive gold through the psychological 4,000 level for the first time since November. The one counterweight is that the move is now technically stretched. Base case for today, bearish, but oversold. Expect choppy trade around the 4,000 pivot, inside a daily range of 38.20 to 41.14. Holding above 4,007 keeps an oversold bounce alive. Losing 39.52 opens 38.94. Then the 38.20 projection. Watch the dollar index, treasury yields, and the University of Michigan inflation data at the open. Driver 1, Geopolitics. The June U.S.-Iran ceasefire framework, a 60-day memorandum that reopened the Strait of Hormuz and wound down hostilities including in Lebanon, remains in place into the 26th, despite a volatile mid-month and a brief escalation around June 21st. With the shipping lane open and energy flows normalizing, the war risk premium that supported gold earlier this year has largely drained out. The market treats the conflict as contained, not resolved. The unresolved nuclear program is the key tail risk. Driver 2, the Federal Reserve. On June 17th, in the first meeting chaired by Kevin Warsh, the Fed held rates at 3.5 to 3.75% and removed its 2026 rate cut guidance, signaling a hike is now possible. After Thursday's hot inflation data, futures markets moved to roughly a 68% probability of a hike as soon as September, up from about 29% just a week earlier. This is strongly bearish for gold. Driver 3, the dollar and yields. The hawkish Fed has lifted the dollar index to its highest level in over a year, with markets now pricing tightening rather than easing. Gold's inverse relationship to the dollar and real yields is the dominant near-term headwind, raising the opportunity cost of holding non-yielding metal. A pullback in the dollar or yields is the most likely trigger for a relief bounce. Driver 4, the hot PC report. Thursday's May PCE, the Fed's preferred inflation gauge, ran hot across the board and is the proximate cause of gold's pressure into today. Headline PCE rose to about 4.1% year-over-year, the hottest since April 2023. Core PCE came in near 3.4%, the highest since October 2023. Personal income and spending both jumped 0.7%, well above forecast. This cemented the hawkish narrative. This week's calendar. The marquee inflation and growth prints landed Thursday. The hot PC, the final reading of first quarter GDP near 1.6 to 2.1%, jobless claims around 226,000, and durable goods. Friday is lighter but still matters. The final University of Michigan sentiment and inflation expectations, plus month-end flows. A hot expectations print is bearish. A cooler one could spark a bounce. Driver 5, the structural bull case. Central banks bought roughly 863 tons in 2025, well above the 10-year average, and added about 244 tons in the first quarter of 2026. This persistent buying cushions downside near 3,900 to 4,000, and the banks stay constructive longer term. Goldman Sachs targets 4,900, UBS 5,900, JP Morgan 6,000, and Wells Fargo 6,300. Now the technicals. Gold is in a firm downtrend, trading decisively below the 20, 50, 100, and 200-day moving averages, with daily indicators flashing a strong sell. The 20-day average sits near 42.96, and the 200-day near 44.73, both well overhead. A supply zone sits at 41.14 to 41.57, where sellers are active on bounces. This is still correction mode. Momentum, and here is today's key nuance. The trend is bearish, but momentum is now washed out. The RSI is in the high 20s to low 30s, deep in oversold territory. The MACD is turning up from deep negative territory, meaning bearish momentum is weakening. And a daily hammer candle near 39.64 flags a possible short-term reversal. The base case stays sell the rip, but a relief bounce is live. Resistance levels above. First, immediate resistance at 41.14, the top of today's daily range and the key pivot. Above it, 41.57, the top of the supply zone. Then 42.02 and 42.55 higher up. Bulls need a sustained reclaim of 41.14, then 41.57 on real volume, before they gain any genuine traction. Support levels below. The first line is 4,007, the round number pivot that separates bulls and bears today. Below that, 39.52, the intraday support and short trigger. Then the critical shelf at 38.94, the weekly low projection that must hold. A break there exposes the daily range low near 38.20, the bear extension target. Your trade map for today. The sell zone sits on rallies into 41.14 to 41.57, with a stop above 42.02, targeting 4,007, then 39.52. The buy zone sits on a defended hold of 3,900 to 4,007, with a stop below 38.90, targeting 41.14, then 41.57. Price near 40.15 sits right at the pivot, so wait for 4,007 to break or hold. Scenario A, the primary path, around 50%, bearish continuation. The hot PCE, the hawkish Fed, and a strong dollar keep structural pressure on. A failure to reclaim 4,007 keeps sellers in control. A break of 39.52 opens 38.94, then the 38.20 projection. A hot inflation expectations print today would accelerate the move. Strategy, sell rallies into the supply zone. Scenario B, around 35% probability, an oversold relief bounce. RSI near 27, a MACD turning up, and a hammer candle mean the move is stretched to the downside. A hold or reclaim of 4,007 sparks short covering toward 40.59, then 41.14. The trigger would be softer Michigan data or a pullback in the dollar. Treat it as a sell the rip unless price closes back above 41.57. Scenario C, around 15% but high impact, a bullish reversal. This needs a real catalyst, such as a ceasefire breach or a collapse in the nuclear talks, or a clearly cooler inflation expectations print that revives rate cut bets. A surge back above 42.02 to 42.55 on volume would invalidate the bear case, and central bank dip buying near 3,900 to 4,000 could build a durable base. Risk management and what to watch. Event risk is elevated and two-sided, so keep size modest and define stops before entry. For longs, an absolute stop below 38.90. For shorts, a stop above 42.02. Watch the University of Michigan inflation expectations today, the dollar index, and treasury yields in real time. And keep one eye on the Iran nuclear talks. Any breakdown is the fastest route to a safe haven spike. The bottom line for June 26th. Gold has broken below 4,000 for the first time since November, pressured by red-hot inflation, a hawkish Fed, and a one-year high dollar. The path of least resistance is lower, but the tape is deeply oversold with a possible bounce brewing. The line in the sand is 4,007. Sell rallies into supply, respect the floor from record central bank buying, and let the data set the tone. Trade the levels, not your conviction. That is your full gold outlook for Friday, the 26th of June, 2026. If this analysis helped, please like, subscribe, and turn on notifications so you never miss an update. This is for educational purposes only and not financial advice. Trade safe, protect your capital, and we will see you in the next one.